Succession is one of the biggest challenges facing an entrepreneur, and it's of particular relevance in the context of family firms. I prepared this chart here giving an overview of two dimensions of succession, namely on the first dimension, leadership succession, and the second one being ownership succession. We can distinguish between family internal transfer of leadership or management, or as opposed to family external transfer of the leadership. And the same is true for ownership. So we can think of ownership being passed on within the family or outside the family. And we also can think of various combinations of family internal and external leadership and ownership succession. So here in this left upper corner here we have the typical family internal succession, which is roughly 40% of all small to mid-sized business successions in Western Europe. And on that side of the equation, so to say, we have the transfer of leadership and ownership outside the family, for instance, to management, to the existing management, in the form of a management buyout, or a management buy-in so that the new management buys into the company. Or we might even consider a sale of the business and ultimately also the liquidation of the company. If we think about the combinations of family internal and external leadership and ownership, we could, for instance, consider the sale to private equity, partial sale to private equity, whereby the leadership is actually kept in the hands of the family. Or we can think of a combination of opening up equity to outside investors and the partial transfer of leadership to non-family members or professional managers. And that would be, for instance, stock market listing, respectively the IPO. Now, if we think about how to go about succession, specifically small to mid-sized companies, we normally advise them to follow a six-step process. So the first step in this process is to define succession to whom. So to define who is actually taking over, and keep in mind the options that we just have talked about. Hereby, it's very important to keep in mind that there are different time frames that you run into. For instance, if you think about a family internal succession, that might be the preferred option, but that might be more time-consuming to ramp up and have discussion with children, whether they are competent enough and also interested in taking over. The second question to be addressed is then, what is passed on? Here, the question is more about, is the business ready to be transferred? Because it could be that over the life cycle of the entrepreneur, the company has lost its dynamism, it's not so performing anymore, so we would have to kind of adapt the strategy of the company. And it could even be that the entrepreneur over time has kept some private assets inside the business, which would have to be separated before the firm is actually being passed on. The third dimension to be addressed is the transfer of governance. So the specific roles that the new owner and the old owner will have in the succession process. So on the timeline, we would have to define how is management passed on from one owner to the next. So who is actually the CEO, when is that role being passed on, and what are the respective responsibilities of the incumbent and successor when they, for instance, work together at the same time. And then also the board responsibility, and finally, how is equity being passed on over time. The fourth dimension to be looked at is the pricing questions. At what price is the firm transferred from one owner to the next? And of course, price here in this context of small to mid-sized firms, and particularly in family firms, often not only has financial implications. For instance, people might be willing to compromise on the price. So for instance, the current owner might be willing to give a discount to the new owner if there is a social tie between the owner and the successor, specifically, and in particular if the new owner is a child. And fifth question then is, how do we finance a transition? And here we typically see a mix of equity, so equity by the new owner his or her own money. Secondly, we also see vendor loans. So the vendor actually supporting the deal by giving a loan to the new successor. And thirdly, a bank loan. The sixth step is then to define what is the tax and the legal setup. Here we can think of corporate law defining, regulating, for instance, whether assets are being passed on or whether shares are passed on, or let's consider also inheritance tax that might apply in the context of a family internal succession. So if we think about these 6 steps, it's important to keep in mind that steps 4, 5, and 6 are rather of technical nature. There's a lot of expertise available. However, the time-consuming and often the very challenging questions for entrepreneurs, incumbent entrepreneurs themselves, are questions 1, 2, and 3. Also, we need to keep in mind that the questions 1, 2, and 3 have a huge impact on what comes out at the next questions at the level of 4, 5, and 6. For instance, if you think about to whom a firm is passed on, and we would consider, for instance, sale to an investor, a financial investor, so the governance of responsibility transfer might be very short, so and resemble a transaction, whereas when we pass it on within the family, that can be a very time-consuming process along these dimensions. So let's keep in mind, this is a really complex process, and through these 6 steps, it seems to us that there is a useful way to go in order to simplify the complexity.